Hello, I'm David Chaston with 90 at 9, brought to you by interest.co.nz. This week, get everything you need to know in 90 seconds at 9 o'clock. With news, the US is not getting international support for its recent anti-China currency moves. In what is a pointed rebuke for the US, the IMF is standing by its assessment that the value of China's yuan is largely in line with economic fundamentals. But the director of the IMF's China department said they were encouraging China to pursue a more flexible exchange rate with less intervention. If China agrees, that could undermine the US drive to get China to hold or artificially strengthen its exchange rate with the US dollar. And data in China largely supports a weaker yuan. Their consumer inflation rose in July to 2.8%, the highest in 18 months. The rise is largely due to higher food prices, with both pork and fruit prices shooting up sharply. Their producer price inflation, however, was lame, falling 0.3% in July from the same month a year ago. That is the first sign of factory deflation in more than 3 years. And we have extensively covered the US-China trade war and mentioned the new Japan-Korea trade tensions and the developing China-India tussle. But there are others worth adding to the list. Indonesia and the EU are at loggerheads over Indonesia's support of palm oil and deforestation to support that industry. Growing among other retaliations, Indonesia says it will add between 8 and 18% tariffs to EU dairy products. And the EU is likely to do battle with Brazil soon over Brazil's Amazon deforestation policies. In the US, producer prices rose lamely in July, the weakest rise in over 3 years. Clearly, demand is not putting pressure on prices yet. In Japan, their June quarter GDP growth came in much better than expected, even if it was lower than the first quarter. One industry being particularly hard hit by the global economic slowdown and trade wars is vehicle manufacturing. Even though sales were stable in June, the July results are unsettling the industry, and production declines are being reported everywhere. It's a trend that will have huge impact everywhere on global factories. The drop in iron ore price, which exceeded 20% in the last 4 weeks, is accelerating. It fell another 4% at the end of last week. China's steel industry is turning sharply lower. US Treasury 10-year yield is now at 1.75%, a decline from this time last week of almost 10 basis points, on top of the 23 basis points fall the previous week. And gold is slightly lower today than yesterday, down $10 to $1,496 an ounce. US oil prices are up $2 from Friday, but are still lower than this time last week. They're now just on $54.50 a barrel, and the Brent benchmark is lower for the week at $58.50 a barrel. And the Kiwi dollar is a little softer starting the week, now down to 64.7 US cents. That's a half-cent fall for the week, and probably less than what you might expect given we had a 50 basis points OCR cut in that time. On the cross rates, we're down a whole cent to 95.3 Aussie dollars for the week. Against the euro, we're down to 57.8 euro cents. That sets the TWI back to just on 69.9, and a third week in a row where we've dropped nearly 100 basis points for a week. Just 3 weeks ago, the trade-weighted index was at 72.5, so that is now a 3.7% overall devaluation.